Welcome back to Around the Table with Stacy Smith. We're talking about the economy and investing. No one, of course, knows where the bottom is going to be on this market, whether we've reached it yet or not. But Michael, you have studied how long it takes markets to rebound after a drop of 20% or more. So where do things stand right now? Has the Dow, as you know, has already moved its way out of a bear market and into, according to some analysis, into a bull market. So does it look like we are now in that recovery stage?
Are we in a recovery state? I don't know, Stacy, on that one. I do think as an investor, over the long haul, it pays to be an optimist. I mean, Warren Buffett has said that over and over again in his investment career. So I do think longer term, the market is set up to do very well. You look at this year, stock market valuations have compressed meaningfully in 2022. Earnings for companies thus far have remained relatively resilient. I'm sure Kim can talk about that quite a bit. And we mentioned before that the consumer still remains in very good shape. Unemployment rate, depending on how you want to define it, it's still near 50-year lows. But there are warning signs in the market, I think, as we head into 2023. The yield curve, which effectively measures the difference investors can expect to receive from owning long-dated U.S. government bonds versus short-term ones, is deeply negative. Meaning, as an investor, you get paid more in interest by owning a treasury bond that matures in 2 years than you do by owning a bond that matures in 10 years. And that's called an inverted yield curve. And the significance of that historically has been, it's often been somewhat of a good predictor of an ensuing recession over the next 8 to 18 months or so. And additionally, as we all know, the Fed has hiked rates aggressively this year. And it does take a while for those interest rate hikes to work its way through the economy. So I mentioned earlier that, the earnings of companies have remained resilient thus far, but they could become a little bit pressured as we moved into 2023. And I think those are a couple of the reasons why we at Fregasso are a little cautious over the next several months. But I do think the good news is that a lot of the bad news has already been baked into the markets. And as we move forward, and Kim just talked about this earlier, I think what the biggest catalyst for the stock market near term by far is if inflation surprises to the downside and the Fed does make a dovish pivot, meaning that they significantly ratchet down their tone regarding the interest rate hikes for next year. The only other thing I wanted to point out, and I apologize, Stacey, is it's a little bit off topic, is U.S. investors, we naturally focus like the majority of our attention on the U.S. stock market, and understandably so. That's called home country bias. But we do think that international stocks are finally beginning to look more attractive from an investment standpoint, even relative to the U.S. equity markets. So that's definitely something that we're going to be paying attention to as we move into 2023.
I'm going to interrupt before anybody else jumps in. I have a question for you on that one, Michael, as far as the international. Am I correct or incorrect that the European central banks and other countries' central banks, they're more inclined to be raising rates even more than we might be? Does that make those markets still more attractive?
Well, what happened is the Fed got really aggressive in hiking rates in 2022, and the ECB and the Bank of Japan less so. So they'll be continuing to raise rates, probably more so than the Fed into 2023. One of the big things that drives the performance disparity between the U.S. markets and the international markets is currency movements. So the U.S. dollar has been in a very strong bull market really for almost the past 10 years now or so. We do think that's coming to an end. And as the dollar depreciates in value relative to currencies overseas, that is a big catalyst to say that international equities can begin to outperform U.S. stocks on a relative basis. The other big thing to note is when you look at the valuation disparity between U.S. stocks and international stocks, we're at one of the bigger dispersions there that we've seen at least over the past 10 to 15 years or so. So even from a valuation standpoint, it's starting to look a little bit more attractive overseas versus the U.S. markets. But nevertheless, Stacy, there are certain headwinds naturally in the overseas markets that you're going to need to be mindful of as you move into 2023.
Anybody else want to jump in on this one?
Well, I would just caution you not to go back to what has worked for the last 10 years. The interest rate environment's going to be different. The technology has moved on for some of the stocks that you're looking at. And you might want to look at areas that you haven't looked at before. So if you have been a big holder of the FANG stocks, it's time to expand your horizons.
Stacy, you can remember back in the 70s when people talked about the Nifty 50. Some of those companies are still available and some of them are still pretty nifty, but most of them are just yesterday's heroes. They're like buggy whip manufacturers, and what Kim's talking about makes a lot of sense today. As we move through the new world that is not as globalized, the whole game is changing, and it's not to say that there isn't opportunity. There's plenty of opportunity, but it isn't necessarily where it has been in the past. As Mike was talking about, the dollar conversion should make quality international stocks rise just as the dollar falls. This raising of interest rates abroad will make their currencies more attractive and our currency less attractive. And money will go, as an old friend of ours used to say, where it's treated best. And that money, is going to maybe go to international because it doesn't worry about what's going on in Ukraine. It's going to where it can be treated best. And that will cause their currencies to rise and ours to fall against them a little bit. And that will make their assets worth more here and our assets worth less there.
The only other thing I want to add, and Michael said this at the beginning of his comments, is that you really have to look at your time frame. When we look at markets recovering, it usually doesn't happen in a straight line. So if we were to retest the lows that we've already seen, that's really no reason to get alarmed as long as you own good quality and you're a long-term investor. It's really important to not let fear and greed drive your investment decisions. And at this point, this is a normal economic cycle. We're not at the current time looking at anything systemic. And this is why you need to focus on asset allocation, which we'll talk about a little bit more.
All right, we have to take a break. We'll be back in just a moment.